So a big thank you to all of you who take time out and actually sit through, a very interesting set of conversations. I think a lot of takeaways, at least personally for me, when we have been in this space now for a fairly long time. I was just telling me numbers like 4 basis points and potential credit loss across the markets FCI has been dealing with. I think these are the kind of solutions we would love to sort of keep bringing to you all, and more importantly, actually make them practically workable. So while that sort of continues to be our mission, and we look at close collaboration, we're proud of you. I think over the next 40 odd minutes, my sort of clear goal is to ensure that we get even more sort of closer understanding of this whole trade, credit, insurance, and FCI as a sort of cover play. While it's been around for a while, domestically also we've all been hearing and possibly in some cases been witnessing how trade, credit, insurance works. I think it will be a little bit of actually it'll be a huge disappointment and quite a pity if we can't sort of make this really useful for the end audience that all of us are working towards, which is essentially are the businesses out there, right? So 2 interesting sort of backdrops on which I want to start the conversation today. Firstly, I think something that the chairperson spoke about in the morning, Ram mentioned that as well, about the changes we are seeing on the global front. Very interesting times for all of us to sort of operate in, especially the cross-border side as far as trade goes. So what I intend to sort of try and understand with Arun, Imran, Hirwa, and Neil's help, are they really sort of likely to see, are we likely to see potential more challenges from a trade point of view, from a collection, from a recovery point of view, and where can all of them help us sort of manage those risks better, one as far as financiers and players go, but eventually through us to the trade, right, to the businesses that operate in. So let me sort of straight dive in a way with my first question to Arun, right? There's sort of always this feeling about trade, credit, insurance acting as a good fallback mechanism, right? Risk mitigant, if I were to use that word. But is that really what TCI is all about? I'm sorry, I'm using TCI as a short for trade, credit, insurance. You're going to talk about it, next quite some time. So is that really the primary role and restricted to that, or is it not still fully understood by the educated audience itself here, leave aside the businesses whom we are doing this for?
I think you're bang on. I think the whole concept of trade credit, and I'll take the opportunity to borrow some of the earlier speakers' notes, especially Chairman Sir was talking about a working capital gap, Sandeep who talked about the possibility of just the immense possibility of bridging that, 40% penetration, number of SMEs from 52 to 152. So these are, we are in a world of poly crisis, and the last 15 days have shown that. And now it's also a stage of poly opportunities. So trade credit essentially, if you see the evolution, yes, you're right, it evolved from a risk mitigant. But today, it's a lot more than that. It is about expanding your markets, it's about advisory, it's about continuous monitoring of risk, it's about using data, it's about granularly understanding the market and understanding the risk, and then giving that value to your customers. So it's more than just a risk mitigant. It's, I think, a working capital solution. And I think Neil earlier mentioned that earlier you were perceiving credit insurance and factoring as competition. And I think it vastly increases the value of your receivables for factors like in the Factor Chain International to use that and help SMEs to get that bridge, because they're going to have a quality receivables in hand now. So with that quality of receivables, you're going to have better access to finance, you're going to have better access to interest rates. So those are the kind of value adds that have happened, and it's just not a pure risk mitigant. I think we've evolved a lot from that, but you're right. It started off as a risk mitigant to large corporates, and now it's evolved to a point where SMEs, given the fact that the working capital gap is what it is, and this is going to be probably in the future, along with FCI and those kind of joint approach, will help literally open the doors for SMEs in terms of how much access to capital they have. So that would be my initial thoughts.
Hey, thanks, Arun. Imran, moving on to you. I think through the morning we've been quite in detail talking about potential changes and clear shift towards more digital trade happening, not only in terms of documentation, exchange of information, but possibly also, long moving in line and eventually money movement as well. As an insurer, right, with that kind of global presence and access to maybe real-time data coming through all these channels, do you see any major changes that are already happening or likely to happen from an underwriting standpoint for the insurers? And what would sort of that mean in terms of how you approach this space, right? For example, looking at whole turnover as a traditional model of underwriting, do you anticipate that will also change over a period of time where one could look at fractions of that whole turnover or maybe a transaction link cover coming in over time?
Well, thanks, Vinod. Just to add what Arun was mentioning on the earlier point, along just being a risk mitigant trade also one important factor is it helps in the collection actions. So before an exporter knows about that there's something wrong at the back end, and some of the insurers have their own collection, in-house collection. Sometimes we use external collection agencies. So other than risk mitigant, it also helps the exporter in early collection. And while the exporter can continuously focus on their core business, and once it is credit insured, the insurance company comes into the action and do the follow and collection. And a lot of times early collection helps in recovery as well. So if you see the data, I think 50-60% of the times once we do collection action, we are able to recover the debt. Now coming on to the question of digitization and how it has helped the underwriters, definitely digitization, the most important factor is it helps in real-time availability of information, so that helps in speed. And once we are able to get the data on real time, we are able to get the limits very quickly, so which helps in the policyholder, whether it's a bank or an exporter, to take a decision on a right time. Secondly, although real-time availability of information is important, the quality of information is also important. As Andre mentioned, blockchain. So the accuracy of information also improves a lot while the information is digitized. As an underwriter, these two things are important, but what is very important to us is whether the quality of the buyer is good or not, the financials are strong or not. So that fundamental remains the same, even if there is digitization. We want to make sure that the quality of the buyer is really strong. And I think Arun would agree to me on this. As an insurer, we do not like anti-selection. We want spread of risk, multi-buyer, multi-seller. And also, if a risk is transferred to the insurer, we are part of the ecosystem. Not that something which is not good to the bank is good to the insurer. I can say the other way around, that something which is good to the bank as a risk may not be good to as a risk as an insurer. But something which is bad to the bank is definitely bad to us. So we want to fill in the trade credit gap, in terms of if there is capacity constraint on the banker side, if there is availability of information is not there because of the presence of the buyer in a different country while we are present in those countries. So that is where we want to bridge in the gap. On the second part, whether we are moving more towards single buyer transactions or not just the whole turnover policies, while we love to do the whole turnover policies, in case there is a segment given to us which is logical, not based on anti-selection as I mentioned earlier. So for example, a sole supplier policy where there is a supplier, he brings on 4 or 5 buyers to a bank to do a RPA, and bank gives that entire 4 or 5 buyers to us. We are happy to do that. But in case within that 4 buyers he says, I want to do 3 with 2-factor, I just want to give you remaining 2 just because it is not able to come into the category of 2-factor. That is where we do not find it interesting. So we would, as insurance community, we are part of the ecosystem wherein we want to participate, and not just that something which is not within the parameters of the bank is transferred to us. So that is my 2 cents on that.
So in fact, just on that point, Chairperson spoke about the changes to guidelines that came in, and obviously are huge enablers for IT-first platforms like us to sort of drive this access to credit to the smaller exporters. I think we actually tried for the regulator to permit a whole turnover-based policy now, which is obviously something that financiers would like, and more importantly, a lot more feasible to get insurance cover against that. As globally, I think it's been tough to have a transaction-linked insurance play coming in. So I think we're just hopeful that over the coming months and years, that will go a long way. Hirwa, EXIM obviously is not needing any introduction. In this room, of course, even India EXIM does not need any introduction. But for someone who's really looked at a much larger sort of play historically as sort of an indirect credit player, the transition to India EXIM, which is a direct credit play, in the backdrop of all these changes, digitization, data documentation movements, how are you sort of adopting those practices? What is really India EXIM's approach to sort of create a big play in this space?
So, I think for EXIM also, the idea that we wanted to, have a separate entity especially is also more, I think, the same problem probably the IBUs are facing here, that when you're part of a larger ecosystem, your focus is on the big, big picture. And the big issue we were facing in our ecosystem is that, likewise the country, we also wanted to play a larger role in supporting MSMEs. And the best way to try and help MSMEs is how do you get into a credit finance where you're not directly taking away, or asking for the collateral, but there are indirect intervention, be it through letters of credit or, giving our enhancement to LCs, and also factoring. So I think what Neil said is an excellent, four-pillar model, where when you're playing the role of an export factoring company, which we are playing right now, we are more than equipped to assess the credit worthiness of the supplier, because I am in this market, I am in India, I have a fair understanding of how is the exporter's performance over the last 2 or 3 years, whether he has a genuine intent of doing a trade, and at the same time, equally I am not equipped to know the credential of the importer. And that is where the partner import factor helps us underwrite our risk, either through FCI, where it's a four-pillar model, or maybe even through an insurance company, because these insurance companies have network worldwide, and both parties are covering different aspects of the transaction, where I'm getting an assessment, fair assessment of the intent of the exporter. With that, when I'm okay to set up a limit, I have a partner, either an insurance or an FCI import factor, who are well equipped to cover the risk. And that is where I think our institution felt that maybe it is the right time. And 10 years ago, 15 years ago, maybe this might have been difficult because we did not have access to digital authenticated data across the world. India, I think, has progressed very well in this space, and today, I think, including all our fellow bankers will be accessing, GST is a game changer for you to assess, the domestic part of, whether the actual sales have taken place, whether the returns are filed. We are hoping that, the digital access of, DGFT's data, the, export bill access, which anybody today, irrespective of you understand the market or not, publicly available information is there, is going to help all of us a great deal to at least minimize, to the extent feasible, the risk involved. And factoring, of course, under the gamut of Factoring Regulation Act, and also being part of the IFSCA ecosystem, it is very easy to get, digital access of documentation. I think you all as platform are anyways doing. But for us as India EXIM, we are also getting into the space where, to the extent feasible, we want to digitize all our operations, we want to digitize our documentation, we want to digitize our KYC processes. So I think with the gamut of huge technology available, fintechs available, many of them are recognized by regulators, it's going to help us great deal in going through this process. Although we are a new player, but we are fairly confident, and especially, I think, as you rightly said, with the latest amendments, where gold turnover is allowed on the platform, we would feel that we will be now able to play a larger role, because to be very frank, personally we feel that in international trade finance, the way the trades have happened in India, because it's an anchor-driven model, right? And being an Indian entity or an Indian financer, I'm fairly confident of an supplier and the buyer both being Indian parties. But when the same model we want to, at least in the initial phase, implement in the international market, rather than an invoice-specific model, we personally prefer, a whole turnover model where that trust is built over the period. I'm not too sure. 10 years down the line, 5 years down the line, maybe we'll have a more robust ecosystem, more technology available to assess the intent of all the parties. But as we speak today, I think the latest amendments have, I would say, has boosted our confidence to participate on the platforms more now.
Perfect. Fully agree with you there. I think there's so much to sort of, start covering. 95%, I think. Like I took 4 basis points back from you, he's taking 95% back from us. But that's true. Open account actually needs a very radical thought from all of us in the room to solve. And you spoke about, more changes also being sort of worked upon at a macro level, if I can call it, within India. So I'm going to come back to you on this part of TradeNet announcement in the budget, but I'll keep that for later. Neil, you obviously spoken about the FCI journey also earlier on, and you spoke about, in a way, 20 years back, acting like a fintech and putting that system together. But to drive that change across 400 members, right, one is of course EDIFACT or EDIFACTOring. I mean, that's you well known, and there are friends like Ravi who will swear by it. But if you talk about the next set of changes that Andrew has been warning us about, whether it's MLETR, whether it's DNI, how do you see FCI sort of being in a position to drive that across its entire ecosystem?
Yeah, I think from a digital perspective, what we need to do is really build relationships with the large corporates to drive this. So one of the things that I've done this past year is built a relationship with several universities in different parts of the world. One of those is in our backyard in the Netherlands. A gentleman by the name of Mikkel Seaman runs a supply chain finance group, and it's focused on corporates. And his whole goal is getting from the physical to the financial. He doesn't want banks involved. It's not a selling tactic. It's really understanding the issues in corporate space, because that's where the problem starts. Right? They're the ones that start this transaction before it ever gets to us from a financial perspective. So to me, we need to solve that piece at the corporate level and bring them into the conversation. It's tricky to do that because if we brought a corporate into the room right now, we'd all jump on them, right? Because that's what we do as bankers. We want to sell them stuff. So what I found is that bringing universities into the conversation, it allows the corporate to open up a little bit more and actually talk about the situation. I did the same thing when I was in Shenzhen in October. I met with a professor there who runs the supply chain finance, just like Mikkel, and I put the two of them together to say, listen, 2 of the biggest markets in the world, Europe and China, and you've got universities here that have an interest in teaching their students about it and bringing corporates in to understand the situation. So I think that's the first piece that we really need to focus on. I want to go back to the LEI conversation, because I think for us as banks, financial institutions, that's a form of digitization that we need to really take a hold of. And I want to use a live example that happened to probably some people in this room, Target. If you're familiar with the U.S. company called Target, large retailer in the United States, big box, some people use that term. You hear Target, you think, well, Target United States. Target had a Canadian arm, and a lot of its product for the U.S. was being bought by the Canadian arm. And many banks that were doing business with Target Canada didn't realize they were doing business with Target Canada. They saw it as Target in their systems, right? So talk about digitization, a great example. Once they realized that Target Canada filed bankruptcy, which was unheard of in the market, because Target is a strong corporate, still a very strong corporate, but they legally filed bankruptcy in Canada. Now Target made them whole, ultimately, so there's a good news at the end of the story. But during that transaction, when it went bankrupt, if you thought you were doing business with Target and you were doing business with Target in Canada, you could have lost all of your trading assets, right, and all your financing. If you had been using the LEI for Target USA versus Target Canada, you would have known exactly where your risk was. So when I hear that question of digitization, what I bring back to banks is, we need to start simple. That's simple, right? That's going from letters to numbers, and that's the simplest thing that we can do, but we don't do it, unfortunately. And then final, I think you made a great point, Imran, about whole term. When I show that 4 basis points number, and I show that 3% dilution, that's because it's a portfolio, right? It is a whole turnover. If I look at any one invoice, that one invoice could have 100% dilution and 100% credit loss on that one invoice. So, I think it's important to understand whole turnover versus single transaction. Single transaction can be done, but you've really got to secure it on both sides of the transaction, the seller and the buyer, to make it work. So I think you brought up a really good point that's something that we, I think, need to embrace as an industry, is the value of that whole term versus a transaction.
So in fact, that's probably going to be unique to the cross-border space. In domestic, in fact, it's not been easy. There have been a lot of attempts to, in India, what we call as cash flow-based lending, right, on the domestic side. Even there, I think people are really sort of, as bankers, as the ecosystem players, even platforms like us, are really sort of realizing that scale lies in having relationships established over a period of time, even in between the financier and the ecosystem, not just in between the buyer seller. So fully agree with all your views on the whole turnover part. And it's actually quite interesting what using universities as a mode. I think something that Sandeep spoke about earlier, right? Maybe it is time for some of us to come together, as insurance players, as FCI, and we have to participate in whatever shape and form, to sort of maybe try and create some sort of a knowledge pool or a content space, including maybe formal training to be made available to players across the industry. And then what better way than probably looking at Gift City as a start for that, right? Just before I go to the next question, maybe I'll just put in a small plug. You spoke about IDI earlier in your speech, and now hopefully very soon by now we'll be able to sort of also solve that for the larger audience in this room and the rest of the country. We are on a path to get our accreditation completed with Life, which is essentially a global G20 body for permitting LEI issuance in different markets. So we will hopefully share the good news with all of you all at some time that Vina will also be one of India's few LEI issuers as such. Yeah. Let me sort of come back to you with my next thought. Gift City sort of now evolving in scale size. Sandeep spoke about 700 institutions, 30 plus sort of IPUs in a way. Now, one of the challenges, and I'm going to be quite open and shameless about this, as platforms, right? Domestically, TREDS had its own journey, where RBI and eventually a lot of regulatory and ministerial sort of efforts also helped bring more and more participation on the platform. A lot of friends in the room, back in their head offices as well, I think, are warming up to the idea of having a marketplace which sort of brings buyers sellers together, does a lot of KYC and everything in place, and has good filtered trade sort of coming up there for financing. But I think it still needs a little while or a little more push for them to sort of start getting active on the platforms. You've been one of the first sort of participants and advocates from a Gift City point of view. What is it that you think will drive more adoption? What is it that needs to probably be done differently, given that you've been a participant here and now on the platform?
So it's a difficult question. I'm not too sure what can work, what cannot. But my bit of a thought basis the success that we had in trades, and I was talking with Supriya sir also, is that when trades was first introduced, it was, and till today, I think only MSMEs are participating in terms of the one who are benefiting out of the entire system. And the financiers are getting benefit when they are funding such invoices that it helps them achieve their PLI target. So if it can help, some incentive to the financier that, if we are participating, and I would like to assume that most of the ITFS, customers or the sellers are going to be coming from MSME space. So if that is the case, then there can be some incentive which collectively the entire ecosystem can think of. The other way is that, as I told you, I think today with insurance coming in, with FCI, so even if we are, I would like to assume that when we are using platform, but if it's a whole turnover, Maybe I think we can put forward a case with FCI also, because ultimately what FCI needs is that the entire turnover, whether the invoices are getting routed through a platform or not, the financer can still continue to upload the detail on the yearly factoring, because that's where we connect with the import factor. But with whole turnover now feasible on the ITFS platform, we see great opportunities of risk mitigation through the insurance or through the FCI, and that probably is going to help a lot of the IPUs, because I myself aware that when we started a year ago, we also had the same challenge that while we were open to doing factoring transaction, it is difficult to do risk underwriting when it is only an invoice specific, at least in the international space. So when you are going to do whole turnover, we now have a lot of players and the instrument available which can help you additionally underwrite your risk. The second part is that I think from what he gave us in terms of the past background of the delinquencies. So probably I think, and we have Ravi from India Factory who's a veteran, so maybe he can post our session, can share some of his views. We are a new player, so we may not have the historical data of how has been our history, but I would like to believe that factoring conceptually is one of the most ring-fenced transactions for a financier. I mean, in India, when we are doing, gradually the world is shifting to transaction where you're near to the cash flow, right? So you are financing an exporter only when a supply has taken place. Okay, so you have a proof of the delivery or proof of the commitment that the exporter was to make. Only then you are going to be financing him 80% of the invoice as advance payment. And the party who is the debtor is actually going to make payment either to your account or through an import factor if we are going through an FCI. So you are almost as good as near to the cash in the entire system. Vis-a-vis a conventional lending where in good faith you are going to give the money to your borrower, anticipating that he will use it for the stated purpose. So ideally speaking, theoretically, factoring is one of the most ring-fenced transactions for a banking perspective, where you don't need to ascertain the end use. The use is already done, you're financing as a prepayment, and the party who's going to make payment is actually going to make payment to your account. So it's more to do with, I think, a fundamental shift in terms of how we perceive. I think if some other benefit from the regulator that while participating for factoring, and if those are MSMEs, you get some advantage, some sort of capital relief is going to, I think, take this industry to a next level.
Many other points. So Priyaji, we are going to, I think, collectively keep coming back to you for some work on the capital side. I think that's been a consistent feedback, and I think most of us will sort of agree in the room that probably is going to make this credit play actually reach deeper to the areas that we want to. Arun, coming back to sort of trade credit insurance, right? Factoring penetration or the lack of it in India is a problem that we all been I think aware of and hoping to sort of change it over time. But penetration of trade credit insurance in itself also, right? I think we still see a lot of gap domestically, but today's discussion, I think, will really sort of focus on cross-border. The natural inclination from most of the friends, in terms of the banking exposure to cross-border trade would ideally be against letters of credit or guarantees, or in many forms of PCFC or equivalent buyer's credit, supplier's credit kind of solutions. And globally, I'm sure that's not the case. The penetration or usage of trade credit is much higher. What do you think possibly is the shift that needs to be brought in, either in terms of understanding or practices, to adopt something that has really worked well at scale overseas in a growing market like India?
Yeah, that surprises me too, because this is a product that is actually a no-brainer. I mean, you should really have this product. I mean, this is you're going to give a limit for a certain rate. Just give an example, 100 crore turnover, you're going to give a 20 basis point, 20 lakh, and you've got limits of 2 crores, 5 crores, 6 crores, and you've got 2 that bounce. You're going to pay like a 4 crore claim. That by itself is no-brainer for me. So I'm trying to understand myself as to why that penetration is not happening. There's a couple of reasons for that. The first is the understanding, as you rightly said. The fact that bankers still view this as something there, but we don't know what. But we need to just get that, just give a pause here and just try to make everyone understand that. Of course, most of you do. What do we do in credit insurance and what do you guys do behind? It's something that is not very often understood. So we have a whole lot of underwriters sitting on a whole lot of information with 100 years of history and with also technology assessing bias. Okay, that's a pretty damn good reason for understanding the limit and as an advisory telling the customer that look, these are red flags probably and these are monitoring. So I think that aspect is not fully understood. The amount of effort that gets into a assessment, if that is truly understood, and that's a good value. The second challenge would be the policy itself. It's always perceived that it's a complicated product and it's a million things you have to check and do, and the policyholder is like, oh, if I do this, will I breach it? It's not a complicated product, to be honest. It is following some basic guidelines for which our own people then reiterate the training to policyholders. And over a period of time, we've seen that having got digital tools for policyholders to do the basic stuff like declarations and outstandings and premiums, etc. But the main challenge, I think, is the distribution. And that's where the challenge is, at least in India. We're not able to get the message across saying that there is a product like this available. But how do you explain that the private market for credit insurance, you're going to just not believe this. There are just about 1,200 to 1,300 policyholders in a market of God only knows how many, 50,000 plus. SMEs, more than 200 crore. And this is the sweet spot for credit insurance, the mid-cap, mid-market kind of segment, not the large ones. They have good credit control systems anyway. But what happens to those guys who are more than 50, 60,000 and the penetration is like 1,200 and the total premium size in the market is even more amazing. It's just about, on an ECGC, it's about a 600 crore kind of premium over the last 20 years. So that begs the question as to whether enough has been done on the education and dissemination of what a credit product actually does. I think that's the big challenge here. I think distribution is one big thing. Education, corporates, like you said, having seminars, etc. One of the challenges we also face is the gestation periods. You know, a product like this is a push product. And India, at least, people perceive this as a cost. And that's a big challenge for us. Because very often you have, from prospect to policy, if it does, it's about 6-7 months. That's not a great incentive for an agent to go and sell it. Okay, that's another challenge we face. And as far as the banks go, I think the SMA requirements, I think, okay, we mentioned capital relief first, but one of the things we do have is that we can do a 90-day period. It's not, we know that the SMA norms are taking place. But I think, as Imran also said, the collections part, these are value-added services we give. Okay, you start collecting, you got debt collection services, you got legal services, support, advisory. So you've got a whole suite of products, of services that you can offer, but unfortunately, that's not gone out to the market in the way it should. And going forward, I think FCI, these kind of joint efforts to push it, I think that's really where the key is. And really, it is just the tip of the iceberg that I could probably have, I know, so many use cases where you could have, I could demonstrate that this kind of, I'd definitely like to mention one. During COVID, you've got to know this, that our involuntary withdrawal of limits, which is what we do as, you will give a limit and you take it back, was 0.8% during COVID. So that just proves that we just don't give a limit, withdraw it just because the tide's turning against us as insurers. We still carry on with business, carry on with people who want to carry on business. We work with them. So that's why our involuntary reduction, we know very well, is if you pull limits, the supply chain gets disrupted. He in turn will not get paid. So the thing is, they're very flexible that way. This product is a very flexible product in terms of structuring the policy, in terms of giving, flexibility in payment, rotational billing. So this is a product that is customizable depending on what the business is. And one other thing I'd like to mention is our risk underwriters just don't see financials. They go way beyond that. They talk about buying behavior, talk about trading volumes, credit history. In fact, some even visit our prospects to just understand the business. So it's a lot more than just an analysis of financials, giving a score, setting a limit. It's a lot more than that. But I think those activities need to be communicated better. I think as a group, as a community, I think the open account community, as I might put it, is something that we'd have to challenge. It's a challenge, definitely. It's a largely unpenetrated market, but I think the scope is, as I told you, the numbers speak for themselves. I mean, you cannot have penetration like this. You definitely have to have much more. Europe, I think, is about 20%. US, for example, is very low. That's an interesting one, right? It's about 2% or something. So India's, it's way below that. But what we find is that Asia is now the next engine of growth. And so use case, of course, is one, that was COVID. The second was, I'd like to talk about some of the users of credit insurance. For example, any company with low margins, they have to sell on credit. That's the USP. If they don't sell on credit, they're not going to sell. And it's competitive out there. So they would end up with a claim. Suppose buyer doesn't pay, and the margins are very low. What happens then? So the entire cash flow gets disrupted, their working cycle gets disrupted. So that's where credit insurance comes in. And we've had a lot of these torpedo claims being settled very seamlessly in a short period of time. So this helps those kind of companies, typically on a manufacturer, distributor, retailer model, where credit is so important. And of course, it opens up opportunities, like I told you earlier, opening new markets and expanding your base, especially now, as Supriyo said, that it's a de-globalized world, and now we're going to be looking at corridors, but then you have to, and customers also have to expand their base. So this helps a lot.
Thanks, Arun. Imran, you mentioned about what's bad for the bank is bad for us, right? So I just want to sort of take that conversation from Arun one level deeper in terms of operational situations. So as an insurer, right, you're obviously sort of offering credit protection, and let's look at financiers, for the benefit of this room. How would the actual process work if there is a eventuality or a situation unanticipated, the buyer does not sort of suppliers perform, but the buyers actually, for whatever reason, solvency or otherwise, not gone ahead with his payment. When does the insurance step in? How does the bank eventually stay protected? Not sort of withstanding the obligations from an SFI reporting or otherwise, but at least from eventually ensuring that within a finite period, their position is taken care of.
Again, being a credit insurer and ensuring global 1/3 credit insurance business, just as a community, wanted to add the reasons why the insurance has not penetrated. I think Arun was bang on a lot of things. I think we started in India as a T20 match under 2009-10. There were a couple of wickets which fell 1, 2, 3, 4, 5, and then the same T20 match became a test match. And then the regulator was not kind enough, again, both the insurance regulator and the RBI. Till now, they are not so kind. So that is one, reason the product did not, did very well. I was a banker in the Middle East, and then I started doing credit insurance as a broker. So I would, keep knocking the doors of corporates. It was a pure, risk mitigation product, and everybody would say that, I know the buyer very well. I'm doing business from last many years. In case it's a domestic business, he said my uncle is the son-in-law of, the brother-in-law of, something, and I'm going to sit in his house and get the money. I think now we are at the cusp of, in India, in making history. I think GIFT City is one catalyst. IDFS could be one of the catalysts. Digitization again, is one more catalyst, and also, most importantly, once we have that capital relief, which we've been knocking the doors of the regulator, and being a AA rated insurer, I think rather than a push product, I think a lot of banks, SMEs, where they get the real benefit of immediate liquidity, the product is going to do very well. Secondly, on the question of probability of paying loss or not, honestly, in credit insurance there is no probability. Either we pay or we try to pay. There is no probability of not paying until unless the timelines have been done well. So you're asking how does the timeline work? Just to give an example, so there's a credit period, there's a extended credit period. We call it automatic extension. Wherein in general business scenario, in case you do not get the payment on day one, you don't stop your business, you continue doing your business. So we can give an additional credit period of 30 days, 60 days, 90 days, even 120 days, depending on the nature of your business. So that way the product is very flexible. So credit period, MEP, which is the extended period, and then there is a claim notification period, which is generally 30 days from the expiry of the MEP. So once the non-payment notification is given to us, that is where the claims waiting period which is 180 days from the notification of non-payment, or some insurers say 180 days from the oldest unpaid invoice. Within that 180 days, the insurer tries to through their own in-house collection agencies try and recover the buyer, understand what is the challenge the buyer is facing, come to a solution. In case buyer is really in a cash flow problem, the money is not going to come in. You submit all the documents, ledgers, claim form, and copy of invoices. It's very easy in case of export because the documentation are much more clear. In case there's export business, domestic still there's a gray area, but post GST I think things are much clear in terms of understanding that there was a delivery of goods, there was acceptance of goods, and there is a non-payment. Sometimes there could be a gray area which is called as commercial disputes. Even in factoring, it comes with a rider, even if it is non-recourse. That commercial dispute is we are going to go back to the seller and claim our money. So unless and unless there is a commercial dispute, there is no gray area, and the claims get paid. So these are the timelines. While one of our banker friends was mentioning, due to SMA reporting, the timeline has to reduce to maybe 90 days. We are working on that, even not for banking purpose, for our regular corporates also. That in case something is not going to get recovered, there is no point waiting for 180 days. We should pay in 90 days. So we are working on a project. Hopefully, we should be able to support that. And in case of SMA reporting, if we are able to really make it 90 days and pay within that, I think the product, on the first part of the question, the product will, do very well.
I think that's not really welcome thing, and I honestly, my first reaction, I would sort of expect a huge change for the banking industry sort of also approach this your solutions, because I think it solves one cardinal issue for them: how much do I report, and how much sort of can I expect as recovery. We are sort of close to 2 o'clock. We'll give a short sort of session for Manish after this, so I'm just going to have one last sort of question for each of you. Think of it more like a rapid fire one, if I can say that. Neil, you spoke about export financing. Factoring is often discussed, well understood to a decent extent, by audience like this. Import financing, right? You touched upon it earlier, and in a country which is a current account deficit, and we are likely to be that way for at least the foreseeable future. Why are more solutions being thought about from the ecosystem? Banks obviously are trying to stop it in their sort of way, but what is it that we can do differently? What is FCI's view on this whole import financing opportunity?
I think it's specific to India. It relates to the ability from a regulatory perspective to cover import finance and import factoring. So that's the challenge today. We have 2 members here in India today that are banks. I won't mention the names, but both of them had a heavy interest in doing import finance and import factoring last year. We spoke with them, we did training, we walked them through it. They never implemented it. And it was because of the regulatory issue. So I think that, again, I like to not talk in theory, but actual. That's 2 actual cases that happened here in the market where you had an opportunity to provide financing for importers and they couldn't do it. Right? So to me, that's a big opportunity. And it really goes back to what's been said many times already this morning and today, is capacity building. Just like was said here on stage, is there's an opportunity for us as an industry to raise the knowledge level for import and export open account financing, and to do that university level, the corporate level, the finance level. If we can bring those groups together to raise that capacity and understanding, everybody wins. And again, I go back to those two real world cases from last year of two corporate banks that want to do this business, spent the time to do it, and then as they reach the finish line, they realize we can't. So I think that's a big opportunity,
So I think we will look to sort of work together to see if there's a sort of more innovative approach we can sort of use, and also take the FCI help in sort of getting more banks interested in the import space, because I think you're also talking about domestic risk to businesses, corporates as the larger bank, even domestic zone, each of the banks will probably know well, right? Arun, there was some discussions earlier, and even in our conversation, we spoke about TREDS being a very good example of how a collective shared marketplace infrastructure can go a long way in solving a particular space issue. I think we believe strongly, and that's why Bina stays committed to this whole idea as a opportunity. Do you see a moment like that occurring over the next few years as collectively we all work together? Is this something that all the audience in this room should be not only deeply interested in as an audience, but actually start getting associated with?
Yeah, I would like to jump the gun here, but we're working on it. We're working on the domestic piece. That's relatively a better piece in the sense that starting with the SMA norms, etc., the losses are almost negligible. But what's more interesting is the amount of data that's been analyzed and using data as a tool to make logical, rational decisions. I think that's where it's all coming from. I think if you see the trust platform, whether it's any exchanges, the granularity in which the data is collected, disseminated, and decisions based on that is unbelievable. It is really something. So the similar thing would happen, is obviously happening in the ITPS platform also. The challenge is that, to be honest, it is still early days. We're not able to do an invoice level kind of insurance, but on a portfolio we're looking at it. And definitely as insurers, as cross-border insurers, we do have the expertise of assessing a buyer outside of India. And in fact, that's the reason why we have underwriters sitting in that location. So that gives a big advantage to us in terms of underwriting that. But what I think is important is integration of systems, because that's real time. ITF is real time, trends, etc. It is in fact a challenge to us. We have to now ramp up a bit in terms of technology. I think once the technology is there and then the integration happens, then you can have those real time solutions. So it's still a little way off, but I think we're working on it.
Imran, parting thoughts from you in a way on how can institutions, IBUs, units here sort of look at engaging, obviously, ITLS platforms will keep engaging with them, but from a credit insurance point of view, given that their mandate also is to look at cross-border exposures, what would be your sort of parting feedback?
Since it's a rapid fire, the easiest answer is, Allianz Trade, opening a shop in New City, should be led by Equities, because they are the leaders in India. So we are the followers, and of course Alonso is very senior. So our presence is very important. That is where we can secure. We can be part of the ecosystem. Education is very important, and it's like a symbiotic relationship between FCI, us, bankers, exporters. It is not a competing product. We mentioned a couple of times, just 95% of is not funded. So we need to sit together in close groups, understand, make a white paper, present it to the regulators, and I think we have, though it may take some time, but then definitely it's going to get in place, and it's going to be a success story for sure in New City.
So Sukhji, नया building जल्दी बनाइए, more people coming. last question on the panel. Eva, this sort of goes back to a very interesting announcement that we all heard and then read twice in the budget. This whole potential build out of something currently called as Bharat Trade Net, right? Coming together of multiple institutions, the regulator, the ministries, multiple ministries for that matter, to obviously sort of try and solve this larger MSME, especially export financing play, from acquisition to eventually money in their account. Exim, I'm sure, is actively involved. What is your early reading? What is sort of the opportunity you see ahead if this gets implemented well, and what would it mean for players like us?
So, yes, I think it's this time round the budget had big announcement for a lot of things to do with MSME, including, I think, officially the government has recognized export factoring as one of the key pillars for non-collateral MSME lending. And the BharatNet platform, although early days, but yes, our parent organization is being, approached by government, DGFT, Ministry of Commerce, MSME. And the early days, the information we have is that it's going to be an integrated platform where right from the time that the invoice is generated to the end where all the data is currently being uploaded. So today I think what Andrea said, that with so much of influx of digital infrastructure, most places everything is available, but it's not available at a central place. So in India we have certain things which is going to the DGFT platform or the customs data, something is going to through the banks to RBI, something else is going somewhere else. So the idea is that the government is trying to do is that there will have to be a data, the Bharat Trade Net probably will be a data integrator, where all the service providers are mandatorily required to disclose the information that they are supposed to gather in the early days. And it will be like a central repository where every kind of data belonging to that trade is available probably to everybody, or at least to the regulated entities or the market participant. And if actually that happens, then I think a lot of these issues that we were discussing in the morning, like how in domestic GST is helping all of us, probably for export, it will help us. We do not know if it goes to a much more authenticated tokenization way of storing the data. Factoring companies are like us, may be able to also rely on it in terms of putting our assignment disclosure also on it. We don't know, it's in early days. But yes, I think for factoring, one thing which I think industry perspective is that central data within FCI or within India. So in India we have a lot of unregulated participants also now doing invoice-to-invoice factoring, and it's difficult for us to find out the invoice that is coming to me. I am doing whole turnover, or I'm disclosing it to my participants or my partners like insurers or import factor. But one of the invoice, the same invoice, what if it is going to some other platform, some other unregulated entity? So it's a big issue. So at least if we have a centrally available database, and if my assignment is available on a publicly registered database, at least tomorrow I can lay my claim on it. So I think we have big hopes on this digital public infrastructure that government has announced. It appears that they have serious intent of genuinely integrating every touch points available currently in India. And if that happens, I think all of us collectively are going to benefit out of it.
Thanks, Elva. So this is in a way a hope and possibly a promise to both me and Andre that in India when we move on tech, we move at speed. So hopefully in that sense, the Turkey example in another few years we'll start talking about India as an example there. But on that note, I think a big thank you to all four of you to participate, on this panel, travel all the way also to sort of spend time with the audience. So Arun, Imran, Irma, and me, personal thank you, and from the entire Vayana team's behalf. To the wonderful audience, thank you so much for being so patient, in sort of hearing us out. And we are sort of hoping that this becomes a regular feature from our perspective, coming back to you as a community. Won't take more time before your sort of break for lunch, but for those of you who can, I'll just sort of request Manish to come on stage quickly for a short sort of slides that he wanted to sort of talk about. But in the meanwhile, thank you again.